I'm using $7,000 gold or $20,000 by Jim Rickards or buy and hold. It's worked, it's worked, it's worked. Michael Oliver's talking about $500. So if silver, if it goes to 500, you got to be ready to get out though. If you do physical, even if we go to $500 silver, that'll be an overshoot, I believe, and it'll come back down to 250 probably. If you're wealthy, just do the ETFs and physical or only physical.
In your view, what happens to the dollar, the bond market, the U.S. economy, if China were to come out and announce that they actually have more gold than the United States?
The Hong Kong over-the-counter market within 12 months will be 50% the size of the LBMA. That's a massive impact. If that happens, that means the price of gold will be set in Asia, not in London, not in New York. That Hong Kong exchange has the potential to literally set the gold price. Singapore, they're going to also want to have an over-the-counter market. They can't take interest rates to zero again. He knows if he prints $4, $5, $6 trillion in a year, that he's going to create more inflation. I'm using $7,000 gold to value my miners. But I think that's a conservative number. I really do. And that's 24 to 36 months out. I think that right now, we're seeing some really crazy numbers. You got 17,000 by Pierre Lassonde. And then you have, I think, I've heard 20,000 by Jim Rickards or higher for Jim Rickards. Rickards actually thought we could go to 10,000 this year. So you're seeing people that have these really high targets. And so depending on what the supply dynamic does, these targets aren't crazy talk, but I do think that 7,000 is a conservative number. And the key here is fear. You talk about supply demand is one factor, right? That's one factor. But the other factor is fear, uncertainty. That is what really drives gold, is the uncertainty. A good example is if you are not comfortable with your portfolio in stocks and bonds and even real estate, you want to have another leg on that stool of gold. And there's a lot of people out there that don't own gold, but they do own a lot of stocks and bonds. Yeah. And they've been comfortable, and I think that's an appropriate word, they've been comfortable not owning gold. I don't need no stinking gold. I got my stocks and bonds. They're doing fine. And that their comfort level, it really amounts to one thing, I believe, and it's the stability of the U.S. economy. Because the U.S. economy since 1945 has been a juggernaut. All it's done is go up, up, up. I mean, you can look at historical returns for the S&P 500 since 1945, and it's worked.
The greatest risk often appears when investors stop believing protection is necessary. Don Durrett notes that fear, not just supply and demand, has historically been gold's most powerful catalyst during financial uncertainty. Decades of confidence in stocks and bonds have conditioned portfolios around one economic outcome, leaving little margin if that assumption breaks. Wealth preservation begins before panic replaces complacency. Next, Don Durrett reveals the one scenario where confidence in the Fed could disappear far faster than markets expect.
You just buy and hold. It's worked, it's worked, it's worked. And there really hasn't been a reason to take 10% or 20% of that and throw it into gold, even though gold's outperformed the S&P since 2000, right? But their comfort level, the key one is their comfort level. So what happens if the U.S. economy goes into a recession and the Fed cannot fix it? What happens to gold then? That's my thesis. I don't think the Fed is going to be able to fix it. Now, because historically, they've always been able to. Historically, they've always been able to fix an economic problem, historically. But the difference this time is they don't have the tools that they've always had. They can't take interest rates to zero again. That's not a possibility. And they can't print what they're going to need to print. And Kevin Warsh, he's not a guy that likes to print willy-nilly. So he's going to be behind the eight ball the whole way. He's going to print a little bit and nothing's going to happen. He's going to print a little more, nothing's going to happen. He's going to be behind the eight ball, and he's going to refuse, because what's going to happen? He knows if he prints $4, $5, $6 trillion in a year, that he's going to create more inflation. And that's the kryptonite of MMT. And if he does that, he's going to destroy the currency. So he's trapped. And once that recession starts, we're going to find out. I think that once we're 6 months into the recession, say the stock market's down to around 5,000, and everybody's waiting for the economy to turn around.
The Fed has rescued nearly every major downturn since 2008, but today's policy constraints look very different. According to Don Durrett, persistent inflation leaves policymakers with far less flexibility than investors assume. If recession arrives before meaningful rate cuts or aggressive stimulus become politically acceptable, confidence could erode faster than balance sheets recover. That possibility matters more than optimistic forecasts. Next, Don Durrett reveals the exact moment when fear, not fundamentals, could ignite gold's strongest move.
That's the point when gold is really going to get a bid. Because that's the point where people are going to go, uh-oh. We're going to have our uh-oh moment somewhere between the S&P, between 5,500 and 5,000. Now, a lot of people, that uh-oh moment will happen around 6,000. But most people are like, no big deal. It always comes back. It always comes back. 5,500, no big deal, no big deal. But at a certain point, people start jumping off the ship. And that's the reason why I own gold and silver miners, is because I don't think the Fed's going to have the tools to restart this thing. And the reason why, 10 to 15% of U.S. corporations are zombie corporations. 10 to 15%. So what's a zombie corporation? A zombie corporation is a company that doesn't make enough profit to pay its interest. Just like the U.S. government. They have to basically they have to roll over their debt. They have, give me more debt. So the banks, basically, they can't pay them by with profits. Just give me some cash from the bank and then I'll roll it back to you. 10 to 15% of our corporations are that way. They just, I can't pay you, but give me some money and I'll pay you. That's and so those are the first people to go. Yeah. Those are the banks are like, we got to cut those guys off. We got to cut them off.
Markets celebrate resilience, yet thousands of companies survive only because credit remains available. What Don Durrett is highlighting is that zombie businesses expose how dependent the economy has become on easy financing. If lenders tighten standards during a downturn, hidden weaknesses surface quickly, undermining the comforting narrative that every decline automatically rebounds. Defensive positioning becomes a strategy, not fear. Next, Don Durrett unravels why mining stocks could outperform precisely when investor confidence breaks.
Let's shift our focus a little bit here. There's a lot of analysts out there in the space who, let me say this first. We've seen the returns in the mining complex in the 1970s, and it was unbelievable. And we've heard stories from people like Rick Rule and others who just made an absolute fortune investing in miners. But there's precious metals analysts today who are using their work to point out that in the 70s, gold beat the miners, that the miners actually peaked in the late 1960s, not in 1980. And they're strongly asking the question, why bother investing in the miners at all? Just stay with physical gold. What is your view on that?
So I always say that if you're wealthy, just do the ETFs and physical or only physical. And stay wealthy. But if you want to get wealthy, you're not going to get wealthy buying physical. So unless you got in real early, if you bought silver, we've had a lot of opportunity to buy silver, like sub 20, sub 15, some people sub 10. You had a lot of opportunity to buy gold at 1,500. There were opportunities, but now gold's at 4,000.
Owning gold preserves wealth, but growing wealth often requires accepting calculated risk beyond bullion alone. Don Durrett's argument suggests physical metals and quality miners serve different purposes rather than competing strategies. The overlooked mistake is assuming yesterday's winning asset automatically delivers tomorrow's highest returns under changing market conditions. Portfolio construction matters as much as market direction. Next, Don Durrett reveals why professional investors separate wealth protection from wealth creation during precious metals bull markets.
We'll be lucky if it gets to 15, and you're probably looking at 10, which is not even a two-bagger. So we're at 4, and so there's not a lot of upside left in physical gold, right? You're just trying to stay wealthy. Now, silver, Michael Oliver's talking about $500. So if it goes to 500, you got to be ready to get out, though. So most people are going to do, if you do physical, even if we go to $500 silver, that'll be an overshoot, I believe, and it'll come back down to 250 probably. So you're looking at a 4-bagger from here, 3-bagger. So in the ETFs, you can also get a 3 or 4, maybe possibly a 5-bagger. So physical, it's all about return, what you want, what your strategy is. But I think that physical gold and silver are more about maintaining wealth than it is getting wealthy. And I call the Elite 8, you have the ETFs, and then I call the Elite 8, the top big mid-majors. Those are for the wealthy people. But I use ETFs for diversification. And so I'm trying to get big alpha.
Most investors obsess over returns but rarely define the job each asset performs before buying it. This is where Don Durrett's thesis shifts from chasing headlines to matching investments with specific objectives. Diversification isn't about owning everything. It's about balancing preservation, liquidity, and upside before volatility forces emotional decisions. The strongest portfolios are usually built before markets become obvious.
In your view, what happens to the dollar, the bond market, the U.S. economy, if China were to come out and announce that they actually have more gold than the United States?
Yeah, it would definitely put more pressure on the bond market. Again, for me, it's all about the bond market. Basically, you have 3 things. You have the U.S. economy, you have equities, and you have bonds. Bonds are the most important. But the stock market, the economy has to have enough income, enough profitability to hold it up. And the stock market is kind of the counter, the bean counter, telling you if the economy is holding up or not. And the bond market is really the big gorilla in the background saying, you better keep this stable or else kind of situation. So if China does something like that, if they show the world that they actually have more gold than the U.S. does, it's a destabilizing effect, I think, for the bond market, which is the weakness in the U.S. overall U.S. economy. It's like being a corporation and having too much debt, and you can't service the debt. You're basically become dependent on your creditors, because without your creditors, you go bankrupt. And so the U.S. is dependent on our creditors. And who are our creditors? A big source of them are foreign investors. So those guys could do a rug pull. Now, I think that China's impact on the gold market is significant. And it's not just China.
If China ever proves it holds more gold than Washington, confidence in U.S. debt could crack long before stock investors react. Don Durrett notes the real vulnerability isn't equities, but the treasury market financing America's deficits. Foreign creditors don't need to dump every bond. They only need to question the system's credibility. That shift would pressure portfolios built on assumed stability. Next, Don Durrett reveals why the bond market, not gold itself, could trigger the larger financial repricing.
It's basically all of the BRICS nations, even Eastern Europe, actually even South America. I think countries, Africa, I think countries are buying gold. Central banks are buying gold. All of them. It's pretty amazing. And the reason why is because the U.S. bond market just keeps getting weaker. I think everybody's in denial, thinking that AI is going to save the day. The U.S. economy is going to be the number one economy. Nothing to worry about here. We're not going to have a recession. Everything's fine. So the big unknown here is, what happens if we do go into recession. But I want to go back to China and the gold price and gold. Hong Kong, starting this month, is going to have an over-the-counter market. They've never had one. This over-the-counter market is going to be basically identical to what they have in London. And according to Grok thinks that this over-the-counter market in Hong Kong is where all of Asia will begin to buy their gold. They will stop buying their gold in London. And that could become that could be all of Asia, that could reverberate. But Grok thinks that the Hong Kong over-the-counter market within 12 months will be 50% the size of the LBMA. That's a massive impact. If that happens, that means the price of gold will be set in Asia, not in London, not in New York. That Hong Kong exchange has the potential to literally set the gold price.
Central banks are buying gold, while public attention remains locked on AI headlines and equity rallies. According to Don Durrett, Hong Kong's new over-the-counter market could redirect Asian bullion demand away from London over time. If price discovery gradually shifts east, decades of Western influence over precious metals become less secure. Investors ignoring infrastructure changes often miss the biggest wealth transfers. Next, Don Durrett exposes why the location setting gold prices may soon matter more than the price itself.
And the physical price, historically, New York has used the paper price. The LBMA in London and the COMEX in New York have set the price using paper, using contracts. And now this over-the-counter market in Hong Kong could literally start setting the price. And that could have a big impact. Also, Singapore, they're going to also want to have an over-the-counter market. We'll see how big that one gets. And then Dubai wants to do it as well. And so you have some of these big players, the Middle East and Asia, that want to get involved in the gold trade. So one final point is that I do not think that the Chinese want the yuan to be the reserve currency. Everybody keeps talking about how China keeps doing more and more trade using the yuan. And they're okay with that. But the reason why they don't let it float freely is because they don't want to be the global reserve currency, because they learned the US lesson. If you're the global reserve currency, you have Triffin's dilemma. And Triffin's dilemma basically means that your currency is going to be stronger than who you export to, because they're going to have to buy your currency, or who's basically importers. So inevitably, your currency becomes too strong, and it weakens you as a mercantilist Hamiltonian economy, which is what's happened to the U.S. And now Trump's trying to bring us back into a mercantilistic Hamiltonian economy where we start making our own stuff.
Everyone debates reserve currencies, yet the real battle may be over who controls gold pricing. What Don Durrett is highlighting is that physical trading hubs emerging across Hong Kong, Singapore, and Dubai challenge decades of paper market dominance. That suggests influence could migrate without replacing the dollar overnight, contradicting the popular all-or-nothing narrative. Investors should watch where price discovery moves, not just exchange rates. Next, Don Durrett unravels why China may reject reserve currency status while still reshaping global finance.
But I think it's too late in the game for that. But China doesn't want the reserve currency. But what they do want is they don't want to use the dollar either. So they need some type of a cross-border settlement system. I think what's coming is some type of a stable coin that countries are comfortable using. And I think that the stable coin, whatever stable coin shows up, it hasn't shown up yet, but next year, I think 4 more of the largest Japanese banks are going to come out with a stable coin. That might be it. They might use that. But if anybody can find, if there's a stable coin out there that's liquid, that you can convert, that's going to create an opportunity to be backed by gold. So I think that these stable coins are going to be more and more backed by gold. And a perfect example of that is Tether. Tether is buying a boatload of gold. They're backing their stablecoin with gold. And so I think that's going to be more and more common. I think Circle will start buying a lot of gold. And I think that these new stablecoins that are going to start be popping up are going to be backed by gold. And so I think Japan will, I doubt that Japan doesn't include gold. When they do that stablecoin, I doubt they're not going to include gold in the mix, because gold has an offsetting ability to balance it out. So gold will outperform currencies, right? And so you don't want to use a stablecoin only backed by gold, because you don't want to spend it, right?
The next monetary shift may arrive through payment networks rather than central bank announcements. Don Durrett's argument suggests gold-backed stablecoins could quietly reduce dependence on traditional dollar settlement without dramatic headlines. If trusted digital payment systems increasingly accumulate bullion, physical demand rises even as retail focuses on cryptocurrencies alone. Savers ignoring this structural change risk missing another long-term wealth transition. Next, Don Durrett reveals why gold could become the hidden foundation beneath tomorrow's digital money.
You want something you can spend, cross-border transactions. Gold is something you buy and hold. It's more of an asset. But you can partially back it, which creates less inflation, less deflationary effects.
So, listening to you mention all of these different things, from the companies Tether and Circle, et cetera, to the locations from Shanghai, Hong Kong, Dubai, et cetera, that's a lot of demand in addition to the central banks. It sounds like that's being placed on physical gold moving forward. And supply is so stable, supply has not really changed in 15 years. And there's no new large supply coming online anytime soon. And so it sounds like economics 101, a lot of demand, increasing demand, pressuring stable supply. It sounds like price is the only outlet.
You connected the dots there, Gary. I firmly believe that the chance of what I laid out is going to be the outcome, that you're going to have stable coins using gold, and you're going to have central banks accumulating gold, and demand's going to outstrip supply, and gold prices are going to go higher.
Gold mine supply has barely changed in over a decade, yet new sources of institutional demand keep emerging. This is where Don Durrett's thesis shifts from monetary theory to simple market mechanics. Persistent buying against constrained supply eventually forces higher prices. The overlooked variable isn't speculation, but sustained accumulation from central banks and financial infrastructure. Patient investors recognize these imbalances before they appear in headlines. Next, Don Durrett exposes why today's bold gold forecasts may still underestimate structural demand.